Welcome everyone to this webinar with the Coalition for Private Investment in Conservation, CPIC. My name is Helen Avery. I'm Head of Nature Programs at the Green Finance Institute, and really pleased to invite you to this session where we're going to be discussing the findings of the first Conservation Finance Report from CPIC that launched yesterday. The report highlights the current state of the market growth, where finance is flowing and not, and what the barriers to finance have been to date. So some really interesting data and insights. So just waiting for people to start joining us. But in terms of agenda today, co-author of the report, John Tobin, Professor at Cornell University and CPIC co-founder, is going to be walking us through the key findings for about 10-15 minutes. And then he'll be joined by three other panelists representing finance and project management, who you'll meet a little later. And we'll be discussing the report and how we grow conservation finance. And then we'll open up to a Q&A from you, our audience. So do feel free to type your questions in if you have them into the Q&A box while we're going along. And Juliet is in the background collecting them. Also just invite you to sort of share your immediate responses to the report as John is sharing the findings. So without further ado, I'd love to introduce John and hand over to him to walk us through the report. Over to you, John.
Many thank you. Many thanks. And as Helen said, my name is John Tobin, and I was involved and working closely with South Pole and others on this report. And I think it really needs a huge need in the field. If this sort of information continues to accumulate and build up over time, I think it will actually serve to address one of the biggest needs in the field of conservation finance right now, which is knowledge gaps. But let me just kick off by, again, thanking you for joining us for this launch and mentioning that when you ask people who are working in this field what they believe to be the needs of the field, or what obstacles are preventing more rapid growth in the field, I don't believe I have ever heard someone say, oh, there just aren't enough willing investors coming into the field, or we're all chasing after a small pool of available capital or willing capital, or anything of the kind. In other words, what I'm highlighting here is that if there is something preventing more rapid growth in conservation finance, it is not the lack of investor demand. And that is something that we have seen here, and that is a trend that has been going on for probably at least a decade. Instead, the kind of obstacles to growth that practitioners often refer to are such things as limited pipeline of investable deals, or perhaps a lack of metrics that allow comparability across deals and that are practical and cost effective. And in some ways, the biggest knowledge gap of all is simple baseline data on how much money is going from what kind of actors in the financial world to what kind of investments. In other words, where are the deals? What are those deals? And what areas of conservation finance are they happening in? Is it green infrastructure? Is it sustainable agriculture, sustainable forestry? Is it oceans, etc.? And some of you may be familiar with a couple of studies that have been produced over the course of the last decade, which have provided snapshots of some of this information in time. But the lack of a sort of continuous process of data collection used by a team or set of teams using methodology that is comparable, that has been a very sort of a big obstacle to making the kinds of comparisons that you need to make. That's part of it. The other point I want to mention here is, will also be very obvious to many of you, but the lack of a simple metric, like in the climate space, where we have metric tons of CO2 equivalent, and there are clear, well understood and well accepted goals like 1.5 C or 2 degrees C. That is a huge need in the field, and something that came out in the process of collecting this information. So what did we find in terms of the numbers? Well, can we see this first slide here? There we go. All right. So thank you. And as you can tell, this study was the result of detailed surveys with requesting pretty specific information from various categories of investors and other actors in the field. In the end, investors represented roughly 28% of the respondents, while another 26% were represented by project developers. The largest category, representing almost half of respondents, was this broad category here that we refer to as those who are undertaking significant activities related to investments and project development. The amount of capital that was reported in the form of investments in the process of collecting the data was $1.3 billion deployed in the year 2020. Next slide, please. Excellent, thank you. So in terms of not just the information, but what that information tells us, perhaps it is not surprising to you, but conservation finance as a field is growing very quickly. But instruments and revenue sources are very focused on particular areas. Private equity, some private debt, some limited other types of assets like commodities, sustainable commodities, and increasingly green infrastructure. But the diversification that we would expect would happen over time has yet to take place. Next slide. Thank you. There has been quite a bit said in the process of data collection about a lack of suitable deal structures, and furthermore, the challenge of measuring conservation impacts. In order to address this, there are two clear but distinct things that will have to be done. One is to develop a broader variety of deals that are structured in such a manner that they address the needs of investors in the conservation finance area more directly. That is going to take a lot of structuring know-how. Large financial institutions have, some of them for 5 to 10 years now, been showing an interest in this area, but not all of those institutions have followed up with the sort of structuring know-how that is really going to generate the kinds of revenues that certainly private return-seeking investors are looking for. And in terms of measuring conservation impacts, I mentioned at the start that one of the big obstacles is the lack of comparable metrics, and the fact that in the climate space, there is a universal language, a universal metric that is unfortunately not present in the biodiversity space. Is the solution to come up with some synthetic metrics that will allow you to compare the non-financial returns of a, say, green infrastructure deal against some non-financial metrics in a very different kind of transaction, say, sustainable forestry. Will we ever get there? Will we ever be able to use a single metric to compare the green infrastructure and the sustainable forestry transaction? Not clear. But the first step is going to be to, at least within each of those categories, to come up with metrics that allow comparison within the green infrastructure projects in certain habitats and that use certain methodology. That next step of the broad comparison between different categories, that's an open question at this point. I'd like to highlight from this slide, of course, the fact that the impact effectiveness of various investments and projects is rated very differently by those who were surveyed for this study. You will notice that in the graph at the bottom of this slide, forests and terrestrial ecosystems generally rate very highly in terms of those involved feeling that there are non-financial impacts that are positive, that are delivering environmental returns, and that are clear, even if not always measurable. At the other end of the spectrum, those involved in oceans and coastal area transactions have showed quite a bit more skepticism about about how real those non-financial returns are and how effective the transactions are. Next slide, please. Thank you. From here, I'd like to highlight the fact that the future of conservation finance is looking quite promising on a number of levels. Demand is great and outstripping the availability of investments, and corporates are looking to get into this space. Mainstream investors are at least expressing an interest in jumping into the field. Technology is becoming more and more important to providing the kinds of solutions that we need for this field, and collaborations through different kinds of institutions that lead to the kind of blended finance solutions that we may need are becoming more widespread. Planned investments for 2021, I just want to draw your attention to this graph on the right, which as you will see, tells us that those thinking of making larger investments in 2021 compared to the year before are an overwhelming majority of those who were surveyed. And that tells us something very clear about the direction of this field. Next slide. Finally, at the risk of repeating some of the points that I have made, let me just highlight the fact that the current number and the current scale of conservation finance deals have not resulted in a commensurate increase in capital flows from private investors into biodiversity conservation. So the increase in capital deployed has not kept up with the increase in the interest in the field. That is positive if you are developing projects or structuring transactions, because the demand outstrips your ability to structure and make available those deals to investors. But the need for capital in the field is such that this is turning into a real obstacle. Trends are very much in the right direction. Also, I want to highlight the fact that a lack of generally agreed metrics of non-financial returns are a serious obstacle, and I've mentioned this at least twice before, but what it may be less clear to you is that a lot of work is currently happening in this field, and various metrics have been proposed or are in the process of being developed now. Whether they meet the needs of investors in terms of practicability, in terms of cost effectiveness, that remains to be seen. In addition to metrics, other information gaps exist that are preventing faster development of the field, and this report is a small contribution towards that. And once we have collected these data on a regular basis, that will be allow us to draw conclusions about long-term trends that are based on judgment and anecdotal evidence right now. And finally, collaborations between return-seeking investors, development finance institutions, project developers, charities, and knowledge hubs that we have started to see so much still represent the most promise for short-term growth in the field, and may serve as a essential intermediate step between the very beginning of the development of the field of conservation finance and that stage when commercial capital only may be able to help a large number of transactions actually get off the ground. And with that, I will pass it back to you, Helen.
Thank you so much, John. It was really great to understand better where we are. My quick takeaway is we're heading in the right direction, but there is a huge gap that isn't being closed. So on that, I'd love to introduce our panel now. We're going to join John and talk through exactly this, where now for conservation finance. So today we have with us Nick Moss, Investment Director at Morova. Welcome, Nick. You're able to say a quick hi so we can see you.
Good afternoon. Thanks for having me.
Thanks, Nick. We have Carolina Bagni, Senior Coordinator, Biodiversity and Landscapes Project Implementation at South Pole. Welcome, Carolina.
Hello, everyone. Thank you for the invitation.
And we have Casper Baumann, Partner at Club Mondial.
Hello, everyone. Great to be here.
Wonderful. Thanks to our panel for joining us today. And also just a reminder to those watching, please, if you have questions, feel free to post them in the Q&A. I've seen a great question in chat, actually, that I will get to from Mike, but feel free to use that or either of those and we'll figure it out. So just to start with, from our panel, it'd be lovely to just get your brief reactions to John sharing in the report. Nick, perhaps you can kick us off. What stood out for you?
Yeah, great. Thanks, Helen. Yeah, I think firstly, congratulations to the authors for the analysis and report. I think it creates and shows a very clear picture of where we currently stand in conservation finance. And for me, what's really encouraging is this growing interest in the sector, this growing diversity of actors that the report points to, not just some of the smaller investment houses, but also some of the corporates and larger investors also coming into the space. And that's great to see, as well as the increasing amounts of finance. I think on the other side, what it does point to is there's still a large way to go. There's a huge financing gap there. And what I was reflecting on is really, great to have seen the innovation over the last few years in the sector and this growing interest, but how do we take it to the next phase and really crowd in bigger institutional investors, next set of corporates, and the commercial levels of finance that are really needed in the sector. So I think there's some areas of the report that are really important. It points to some concentration of actors, some need for further diversity and a diversity of finance within the sector. And I think particularly, what needs to be asked next is, through some of the things it points at, like standardized methodologies, standardized products, what will the next set of actors really need? And I know that for us at Morova, we're also thinking about, for institutional investors, what will be the sort of standard products, funds, loan types that will help them to also be encouraged to step into the sector, as well as some of the things that the reports point to, which is metrics as well. And I think we're seeing, encouraging signs like the TNFD, but we now, know from the IPCC report and also from recent IUCN report on species that we really need to start to accelerate. So I think great work, really interesting insights. For me, the question is, so what next?
Thanks, Nick. And hopefully you, Carolina, and Casper will be answering that in a bit of a deeper dive in the moment, and you can tell us. But thank you. Carolina, what about you? What are your sort of immediate takeaways?
First, I want to express the excellent report you have launched. It's very interesting and I'm very glad to be part to share my perspectives from the developer side, right? So apart from the main message of the existence of the financial gap towards conservation investments, I've also expect to accommodate the expectations for both sides, investors and developers. So there is a clear concern about the lack of standardized measurements and the need to assess performance of conservation project, which is a common concern from us out as well. So we know that reporting validated impact is critical to generate confidence in the return of the investments and also to allow for scaling up conservation actions based on the long-term reliability of those projects. So I guess the good news is that several tools and methodologies are emerging, as John comment. For example, the STAR metric from IUCN, which have been launched this week, actually. And this metric exactly measures the contribution of investments on reducing extinction risk of species. So there is this need to have a common unit or a unit to measure the impact for conservation projects or biodiversity projects, such as we have a carbon unit. But this is a process, right? So this is kind of new, the biodiversity conservation, financing conservation for biodiversity, and I guess this common unit will arise in the next years. But there are some tools that are already emerging, so we can accommodate those expectations from both sides.
Fantastic. Thank you, Carolina. And we'll talk specifically about the projects that you've been working on in a moment. But Casper, wanted to get your immediate reflections on the report.
Yeah, thanks, Helen. I think it's interesting to see, this summary of the status of conservation investments and conservation finance. I think what stood out to me is to see that on the one side, there seems to be this large demand for these type of investments, and on the other side there is a large effort to develop projects to get that capital to flow. But I think the report highlights some of the linking elements that are needed to actually make that happen, and I think some elements that are important are the role of supply chain actors and what they can contribute to actually connecting, for example, the production of sustainable raw materials to markets and making that investable. I think the role of intermediaries that can actually translate between the project development side and the conservation or environmental language that is there on the project side, and the financial jargon and also the financial criteria and processes that investors have and use. I think that's also important. And as was mentioned by Nick and Carolina as well, of course, the metrics on how you actually quantify the impact that you're achieving. And I think it's interesting to see that there are tools being developed, metrics being developed, and also technology being used to actually make that possible. But we also see that knowing what to measure is already a huge challenge. But then an issue in these environmental projects often is also that your project site is subject to external factors that you cannot really control. So you may have a certain population of animal species or whatever that you're trying to conserve or to protect, and you're doing certain measures to do that, but then external factors impact your project, such as climate change, changing temperatures that have species move over time, maybe in terrestrial systems a bit slower than in marine ones, but those factors can really mess with your project. And ultimately, even if you know what you're going to measure, the output or the outcome of your project may be impacted by things you cannot control. So that's another kind of complexity that's worth keeping in mind when looking at these conservation projects.
Thank you, Casper. It's so lovely to hear an investor talking with such insight into how projects are, some of the challenges they have. So thank you. And before we come back to you, Casper, and dive into a bit more and the rest of the panel, John, any reflections you wanted to share, having listened to those immediate reactions?
I was intrigued by what Casper just brought up, and as he was describing it, I was trying to decide whether it is any different from any other mainstream transaction in which returns to investors are subject to market fluctuations and market cycles that are beyond the control of the project or of any of the parties in any way connected to the transaction, including investors. On the other hand, I see where he's coming from, and that the being in a living system and in investing in a transaction where you're looking not just for economic returns, but for non-financial returns, that just adds an entirely new level of complexity and unpredictability on top of the market factors and political risks and reputational risks and other forms of uncertainty that any investor has to deal with.
Well, that sounds like we should put the ball back in Casper's court. I actually have a couple of questions, and thanks, John, for you, Casper, and then we'll work through the panel. And maybe you want to respond to John there as well, Casper. But one thing I wanted to pick up on was, it's really encouraging to see that return-seeking investments are increasing. The deal sizes are really small, still 85% are sub $5 million. And it's going to be hard to close that gap with small-scale investments. So, for you, Casper, as an investor at Clermont-Ganneau, what do you think is needed to close that gap, and what is preventing that larger scale funding, which maybe sort of talks to some of John's points too? And I can see a question on the board about whether investors need to change their expectations a little, but maybe you can talk us through whether that's even feasible.
Yeah, happy to take a stab at it, and obviously also curious to hear from the other panelists what their view is. I mean, in reaction to your comment, John, I agree. Conventional investments also have external factors, but I do think that the environmental ones are, yet an additional layer of complexity. And I guess one also has to see where the project site is, right? So I think for some of those conservation investments, we're looking at emerging and developing countries where, the political risks may even be, larger than investors are traditionally comfortable with. So that makes it yet more challenging. But of course, there are also means to address that.
In the end there, I was agreeing with you, Casper, and thinking, yeah, you have all of the other risks that you would have in mainstream investments. And then you have these additional risks that mainstream investors might not be quite as exposed to.
Yes. No, I agree. And to your question, Helen, on the deal size, I think, of course, one is it's important to look at the number of deals that are happening in the smaller scale and the actual volumes that are deployed, right? So a small number of large deals may still mean that a substantial amount of the volume is actually deployed through large deals. But I think in making larger transactions happen, I see challenges both on the supply and the demand side. I mean, on the supply side, in terms of projects being developed, I mean, conservation is not inherently investable, right? I mean, it doesn't create a cash flow if you protect a certain landscape, protect a certain species. So you have to go through a proxy. And one way you can do that is, to invest in sustainable natural resource management, where you protect the environment, but you also produce, more or a higher quality of a certain product that you can then market. Or you go through credits, for example, such as carbon credits or biodiversity credits, where you're, to a certain extent, just deciding by policy or voluntarily that you assign a certain value to a measurable development in your project, a measurable output. And of course, these are new concepts, even if a lot is happening in the space, which means that many of those projects and those concepts, they need to be piloted, and that is often not possible or not sensible to do at a large scale. So there is a process also where transaction structures are being tested, ways of those different actors that John mentioned in the introduction, of those actors collaborating, those are being tested as well. And I do believe that as we see which constellations and approaches work, we can gradually go into larger transactions over time. And then for making larger transactions happen, the demand side is also critical. So there is a lot of demand among investors for these conservation investments. And we've heard a lot about investors' willingness to deploy capital to those projects, but I think that is not equal to their ability to do so. Because particularly large investors that could move big amounts of money, they are often regulated, for example, as banks or pension funds, or they have fiduciary duty towards their investors, which means they simply cannot deploy capital into projects where they have limited visibility on the risk return profile of that investment. Because if they're deploying pensioners' money, they need to be pretty certain about how much risk they're entering, how much return they can expect. And frankly, in some cases, they may just not be allowed to do certain projects for regulatory reasons. So I think even though you have these billions and trillions of dollars sitting there wanting to make a positive impact on the environment and contributing to conservation, it is very challenging to actually find the type of investors and the type of instruments that can really get that money to flow. And for projects that look at credits as a way to generate revenue, there is an additional level of uncertainty around what price are you going to be able to sell that credit at? And that's often influenced by policy decisions, which again may not be in the investors' ability to foresee or control how that is going to develop, which is a challenge. And of course, there are ways to address this, and blended finance is one, where you try to get concessionary capital to take some more risk, to provide a cushion or better conditions for private capital to invest alongside that. And that's certainly a very valid approach. At the same time, designing those blended finance vehicles is also more complex. It's time consuming, it's costly. So it's not a silver bullet either. And we'll need other approaches in the future to complement blended finance vehicles to really significantly increase the flow of finance to conservation investments.
Thanks, Casper. Yeah, I certainly see the frustration that comes with, well, can't we just accept low returns? And obviously we can't. There's a fiduciary duty of these investors, and then it always comes back to blended finance, and there's a frustration because, as to your point, it can be costly and it takes a long time. Maybe switching over to you, Nick, because there was something that caught my eye in this report, and it was that there's a perception how conservation deals are structured, such as steady or high returns, I've just said, or suitable exit options and securitizations were, and I quote, seen as not having improved in the past 5 years, sort of indicating that there feels like there's a bit of a frustration around the lack of innovation. So Nick, what's your sense here? Is this fair? I would have thought, moreover, with Ophelia, one could argue been very innovative. Is it innovation we're lacking, or is it simply we just don't have these large scale projects with that market return yet?
Yeah, I think So Casper picks up on a number of points, which I also think answer this to some extent. Clearly innovation has been incredible in this sector over the last 10 to 15 years in being able to identify, to Casper's point, a set of pilot projects which have tested out transactions, financial structures, even, more financial elements like collateral packages and how best to, maintain and manage risk on projects as well. And we saw that with the first Althelia Climate Fund, which entered the market and was really at first just meant to focus on carbon credits and actually had to swing to looking at the sustainable commodity side also as an income stream, because it was clear the carbon credit market wasn't gonna supplement or be the only revenue stream for projects. So innovation has been important over the last 10 years. It still remains important in testing structures, but to some extent, and in some cases, we are getting to a point where we're starting to understand some of these investments a little bit more, and some of the risk profiles of some of them. In addition, I think that when you look to what a commercial bank may want, for example, if they're going to actually make debt investments into these projects, they're looking less for innovation and more for just a standard set of quite simplistic return profiles on a project. That may mean some compromises, but it also may be attractive to certain other types of actors coming into this. On the project developer side, there still continues to be innovation and a good stream of smaller actors coming in. But at the same time, how do you encourage bigger land use players who have traditionally been, working on land to actually start to transition their business models to be more sustainable as well? And I think there we need to look carefully at, to both Casper and John's point, how you create risk measurement within these structures, how you understand risk, how you even get down to the granularities of some of the transactions or the transaction elements of a project. What we have tended to see over the last few years is we're still taking a long time to get through basic due diligences, basic transaction structuring, but we have started to learn more and more, standard legal agreements, standard risk tools, ways in which we can hedge on the FX side. These things are all pointing to, a need to start to consolidate. And when we start to do that, we will start to see other actors come in. But we also work with a number of banks, for example, and banks themselves find it really tough to look at these types of projects when they're, used to very, very standard ways in which they finance shorter term financing, working capital facilities, these types of things. The longer term financing needed in this sector is not something they're naturally encouraged to be doing. So for them, what they want to see is, standard legal documents, standard transactions, standard structures with clear impact metrics, and not too much that is going to, well, I don't want to say create too many issues, but it can be very off-putting for larger financiers to come into this space. So I would say innovation is very much key, but innovation should very much continue. At the same time, I think we should be consolidating some of those learnings and starting to really look at how we can create more standardized structures and products that will encourage some of those bigger pools of financing to come into the sector as well. And I think Casper's very, very right. The sustainable commodities market has been, and as the report shows, has been bigger in this because it is now a well understood revenue stream. It wasn't, in the last 10, 15 years ago, but now is, and is seen as a genuine way in which to supplement and be the main revenue stream on projects. And I think we will increasingly see, as we learn from those types of projects, complemented by more innovative structures, some standard products that the market can invest into as well.
Brilliant, thanks, Nick. I think this is the perfect segue over to you, Carolina, when we're thinking about innovative projects. At South Pole in Colombia, you've been expanding from this project approach to a landscape scale approach, stacking different instruments into a larger offering. Can you talk us through that and sort of the impact that has had in attracting investors, perhaps any challenges to that kind of sort of bundling of instruments?
Sure. Projects using landscape approaches are kind of trend now, as they make it possible to leverage synergies and multiply impacts and co-benefits within the same region. So a landscape approach allows for a combined strategy of different conservation instruments. So we can combine offer and demand, aligning multiple sources of funding from different sectors in the same territory. For example, we can implement conservation activities for philanthropic or NGO donors, restoration for the carbon market, sustainable agriculture for supply chain companies, biodiversity conservation for companies that need to pay for the compensation obligations for biodiversity credits, and so on, freshwater management, payment for ecosystem services, etc. So all those activities in the landscape enables the coordination of different sectors, improving the efficiency of the investments, and then reducing the risks and increasing the returns. So we have a result of a more robust project in the longer term. And this actually accommodates the risk of those environmental life projects, as Casper commented earlier, for the investors. So, and the main challenge for the biodiversity financing mechanisms is that, as a lot of the panelists commented earlier, the market mechanism is not yet set and regulated, such as the carbon market. So we do not have a established unit. So we do need a better data on impact measurement and a better standardized methodology, so we can report transparently the results, the impact results, and being able to provide this confidence about the returns of the investment.
Thank you. Sorry, I was struggling to find my mute button. That's great. I wonder, there is a question that's come in, and I know you and I touched on it a little bit earlier, but it's from Michael, and it mentions that he saw in the first few slides, it mentioned that long term was perceived as an obstacle, and he says, I would argue that conservation often requires a long term. I know you and I talked about that sometimes there is this mismatch between investors and the project, which is long term. I just wondered how you're looking at sort of building that in, or is it really by sort of stacking the different instruments? I know we often talk about maintenance costs. You know, no one wants to pay the maintenance costs, but that's really what we need. So I'd love to sort of hear what you're doing there, what your thoughts are.
Yeah, the strategy of using combined conservation instruments it's what brings the efficiency of the project or efficiency of the investments and the results. So when you use a combined strategy, you can rely on more confidence of the maintenance of the project in the long term, and thus the lower cost of the maintenance of the activities that must be implemented, and a better report to attract the investors.
Brilliant, thank you. Thanks, Carolina. So I wondered if maybe we start to take some of these questions. I'm just looking at the time, and there's a couple here that I'd love to sort of dive into, and I know I have a few more myself actually I'd love to sort of go through. There's one here in the chat function that talks about, again, it's about this, well, let's take the one on voluntary carbon markets. It's from Catherine, who says, how would higher pricing in the voluntary carbon markets and the development of biodiversity credits change the economics of investment, and how do you see this changing in the future? Casper, sorry to call on you, but I wondered if, as I can't see each of you, whether you might like to tackle this one first.
Yeah, happy to have a go at it. Well, I think if it's a project which has revenues from those credits as one of the major or as the only revenue source for the project, and of course a higher price is a key factor in making a project more attractive from a financial perspective. So I think what could make it easier for an investor to participate in a certain project that has revenues of that nature is if the price were higher, as you know, in the sense of a general market development, or it could also be that maybe certain floors are insured, so they know in a downside scenario they're at least going to make, you know, a certain minimum return or maybe preserve their capital. And that again could be a role for, you know, a blended finance provider to actually provide that floor or provide that insurance.
Thank you, Casper. Nick, any comments from you on this one?
Yeah, I think obviously having a higher price on voluntary carbon will help, and especially in projects where you're looking at different revenue streams from it. You know, it certainly creates a set of incentives for investors to step in. I don't think it can be the only thing that investors are looking at. I think what we've recognized from conservation finance is those revenue streams need to be more diverse, and credits may not be the only way in which they can be on certain projects, but I think for it to work across the land use sector, we do need to have diverse credit, diverse streams as well. But the thing I would say is, you know, we shouldn't fall into the trap of also making them artificially higher. I think in some cases that has been done, and we've seen it in other markets like the renewables market, where actually you then get a market which becomes subsidized. You can crowd out, you know, innovation and private investors as well, or even project developers, because you get uncompetitive practices when you've got subsidized prices as well. So I wouldn't encourage too much artificial subsidization, but it can certainly help when you're subsidizing up front into certain new asset classes or new conservation finance projects as well.
Well, on this then, I think it'd be really lovely to hear from you and Casper actually, of where do you see the opportunities right now? Where is your focus? I know it's sort of talked about sustainable supply chain investments increasing. Where are you seeing it? Sorry, Nick, I'll come to you first.
Okay.
Yeah. Sorry, I'm looking at you, but I don't know.
Yeah, I mean, look, it's so exciting at the moment, this whole sector. There is a huge amount going on, and it's hard to pinpoint, you know, one exact model or type of asset class. I mean, and that is part of the problem, is there's just so much diversity in the sector as well. You know, where we are, you know, starting to see more interest is in some of the larger producers working with value chain players like the bigger traders or the bigger off-takers or even the bigger consumer goods companies that are really particularly interested in making sure that their whole supply chain is de-risked from a nature point of view, but also that they are being able to incentivize their upstream producers from doing those practices as well. So I think when we get those bigger actors stepping in, working to develop conservation models and to find new financial solutions with the scale of capital and resources that they do, you start to get both some interesting and innovative models, but also at a reasonable scale and with a reasonable amount of compensation and assured offtake for those producers as well. Because I think, you know, looking at land use and forest management, these are complicated things, and the people on the ground are often the ones that we're asking to do this. And we're asking them to take on a lot of the burden, project developers in particular, and really take on a lot of the risk. And we really need to think carefully about where those returns are going to come from for them, and with guaranteed offtakes, with more encouragement from the market for sustainable commodities or even credits, then we do start to get some really encouraging signs as well.
Fantastic, thank you, Nick. Casper, what about you? Where is Valmondale looking right now?
Yeah, I mean, I couldn't agree more about, you know, the importance of those supply chain actors. So I can only echo what Nick has been saying. I think what we see is particularly relevant is this shift from, you know, large organizations sourcing basically with price being the guiding factor to large organizations having sustainability and traceability related commitments that bind them to certain supply chains, where they suddenly have an incentive to invest in the sustainability of the production. And frankly, it's not just for CSR purposes. With, you know, climate change, we're really seeing that the quantity and quality of raw material that they're sourcing can be at risk if sustainable practices or conservation friendly practices, which you know often align, are not put in place. And the interesting thing is also that those time horizons, although those large trading and consumer goods companies, they do also have their quarterly earning targets. We still see that they often have a longer strategy, particularly a longer sustainability strategy, and are quite willing also to make longer term investments in their upstream supply chains. So with that engagement, it helps compensate for some of the maybe shorter term horizons that at least some investors have to actually get transactions to flow. And besides, being an off-taker for the product, sometimes those organizations, linked to their climate neutrality strategies, are also interested in credits, which can make it, another appealing factor to involve those supply chain actors in conservation finance projects.
And presumably the TNFD, once it's up and rolling in 2023, might also support further sort of transition of supply chains to nature positive and mobilize capital towards it, I would think. John, I just wanted to bring you in here, because obviously you've got a deeper insight into the report and some of the things around the supply chain investing, and probably have some more comments. So what do you, I'd love to sort of hear your insights.
I wanted to follow up on something Nick said a little while ago, which I think bears spending a bit more time on. And I think it's very important and very insightful of him to bring it up. The fact is that a lot of people in finance, and I am at least partly guilty of this, tend to think that we can structure our way around all problems. There's political risk associated with a particular potential borrower. Well, we structure a transaction that puts a lien on that sort of risky jurisdiction borrower on its export receivables from some OECD jurisdiction, for example, or any other form of risk. We feel that by deploying smart structuring and financial know-how, we can address many of these issues. And indeed, in many cases, it is true. We have a long history of having developed financial products and structuring deals that address needs of clients in a way that is powerful. People wanted to monetize future receivables from mortgages or from credit cards, and we came up with securitization and etc. There's a long story of innovation that addresses needs in a manner that is effective. However, and this is where Nick was going, with each one of those innovations comes a lot of work, a lot of new documentation, and the transaction costs of innovation can be staggering. So indeed, while financial professionals may like the idea of structuring, and maybe many of them enamored of unusual and bespoke structures, ultimately for something to be successful and for scale really to come in, we need to go, as a friend of mine likes to say, we need to go boring. Our transactions need to be straightforward, understood, and to use legal wording that has been developed and applied and tested and repeated at deal after deal after deal, so that we're not incurring the cost of developing that bespoke wording for a particular transaction. And that cuts across sort of all possible costs. So ultimately, what we need to be working towards is, yes, let's structure when necessary, but let's not structure unless absolutely necessary.
Nick, do you want to respond there?
Yeah, no, it's actually, I think John's picked up on it very well. It's something that that we've come across when working with some of the larger financial institutions as well as, and it's a very, very human element to these deals. We sometimes in these analyses talk at macro level, but really there is an individual that has to sell a product to their client on a day-to-day basis. And that product is often the easiest way that they go out and sell that is, of course, a one-year working capital facility that the client wants, and they'll get their basis points and that's it. So to John's point, they all, of course, would love to, but there is this very human element of doing your job on the day, which is that you kind of want an off-the-shelf solution. Now, that is not easy in the conservation sector, I'm fully aware, and that's not to say we should be just solving this by giving everybody a very simple legal document, but there is something in that of how you encourage people to better sell and encourage finance for doing things that are just boring. Unfortunately, I think John's right. You do sometimes need to focus on the very boring day-to-day stuff, because I think we're getting to that stage, I hope, in the conservation finance sector.
Thanks, Nick. I know we've got 5 minutes left, and I really wanted to bring Carolina back in. So maybe we'll have a bit of a whip round last question, and then wrap up for the day. And that's really just, if you were to sort of pick the enabling conditions, what were they? And I look to you, Carolina, first, because I know in Colombia there is some sort of supportive environment there. So maybe we'll take a turn around of what would we really like to see, what needs to be done in terms of enabling conservation finance to grow to what we'd like. Carolina.
Yeah, I guess a robust and a strong conservation policy from the government, because here in Colombia we have a strong policy for compensation of environmental impacts, and this brings the obligation of the companies to compensate for the impact. So we can find those are the companies that are the targeted investors for the national market. So I believe that policies would be a great enabling condition for those to channel those investments for the conservation projects.
Brilliant. Thank you, Carolina. John, what about you?
Well, there are so many things that I could latch onto, but if I had to pick one right now, I think I would have to say that we need to start valuing non-financial returns alongside financial returns a little bit more actively, and ideally a little bit more rigorously, because in many areas we're seeing in willing investors and willing asset managers who are refraining from investing in sustainable finance broadly because they are concerned about the possibility that they may be accused of not meeting their fiduciary duties by maximizing returns for investors at all legal costs. And unfortunately, that sort of returns and maximization refers only and exclusively to economic returns in the short term, to the exclusion of all else. So value those non-financial returns.
Yeah, fantastic. Thanks, John. Couldn't agree more. Casper, what about you?
I think from our perspective, what's important is that, funders that have a mandate to support, innovative structures and projects in the conservation finance space, that they also, make sure that within their mandate that includes a certain appetite to take risk on these new ideas. I think we have a challenge when, innovation wants to be supported, but the risk appetite doesn't match the inherent risk profile of those new ideas. So I think to the extent that that can happen more, that would certainly benefit the sector and allow it to, try and fail faster, and hopefully along the way also find a few good structures and good strategies to get more capital to flow to conservation finance.
Thank you, Casper. Yeah, I can agree. I think we're missing there's a gap I feel that we're missing around using philanthropy as sort of that impact part of, I know I'm just thinking of New Forest, that they did that with the TAP2 fund, but there's something missing there, using sort of family offices or green banks as that sort of risk appetite layer. That's not the right words, but you know what I mean. And finally, with 1 minute to spare, Nick, what do you think the biggest levers are?
I think we've touched on all of them. I would say, one of the things you alluded to, but I think is probably going to be a huge change maker in the market, is going to be a combination of the TNFD and also the EU taxonomy that's coming in as well. I think that really will start to stimulate, not short term, but medium to long term, some really hard look at how people value risk and therefore also look for positive impact. So I think that will really encourage the sector to make quite a shift as well.
Brilliant, thank you, and perfect time. So that's really all we have time for, and I think there was such an interesting discussion. It's such a fascinating report, and just so many more questions. So thank you again to John and CPIC for the report and for sharing your findings today. And thank you to Nick, Carolina, and Casper for helping bring all that report to life. And again, thank you to the audience for joining. Sorry if we didn't get to all of your questions. So I'll leave you. Hope you all have a wonderful afternoon, and I look forward to seeing you again. Thanks.
Thank you.
Thank you.
Thank you.
Thank you. Bye-bye.